So this is Stephen here from Share Navigator with a trade alert on GILD. So as you know, it's a stock we really like. It's really after trending lower now with the broader stock market and indeed the biotechnology index, which has been absolutely hammered in the last while. But we think there's great value in GILD at these levels. So you can see their implied volatility has jumped dramatically. It's up at 47%, and we're looking to take advantage of that today. So we're going to look to sell the $95 put options. So just to put that into perspective, what does that mean? We're going to insure the value of somebody else's shares to the value of $95. So we're happy to own these shares at $95 if they're put to us. And we're going to get paid about $3.40 for doing that. In essence, our break even is going to be dropped down to 91.60. So we'd be more than happy to be participating in the shares of GILD at those prices, and we're going to get paid $340 for doing so. So we're going to move on now and actually place this trade for real. So now we're here in the trader workstation. We're looking at our option quote screen. You can see I've brought up the 16th of October. And we're looking at the puts here on the right hand side. We're going to sell those $95 puts, and you can see the bid-ask spread there, 315 to 330. But I know from retail information those option premiums are actually higher at the moment. So I'm going to go in here and click on the bid price, and that'll open up the order management window. I'm only going to sell a quantity of one. I'll put in a limit price of 320, although I think I'm going to get more out of it. And I'm going to click on transmit. So what we're going to see now is the order profile coming in here, and I'll just talk you through a little bit on here on the left hand side. You can see our probabilities of success here are about 69%. Now if I was just option trading, I wouldn't be happy with that. I'd actually look for more. I'd look for over 80%, but because it's a stock I actually want to own at around 95, I'm more than happy to take this particular trade on at the moment. It's telling me what I'm going to make. It's saying about $345, so already I know the bids are up there over the 340 level. And it's telling me my maximum loss, and that's as if I go to zero with the stock. So I know my break even on this. I'm going to do a presentation on this straight after this trade, so you can go and watch it and you'll see our break evens and everything on that. But let's go ahead here now and place the particular trade. So we'll move over and we'll actually go in and click on override and transmit and send that order into the market. So you can see there already the order bottom right hand corner is sold, and I know I'm after getting all, you can't see it there on your screen, but we're after getting $341 in. So we got $341 for that. That has brought my break even right down to 91.59 on GILD, and I'm more than happy with that. So we'll do our PowerPoint presentation now and talk you through this particular trade in greater detail. So we're on the short put strategy on GILD. So we know this, our psychology is, in this particular trade we want to own the shares of GILD at 95, that's why we placed it. It's considered a mildly bullish trade because if we were more bullish on the underlying we'd probably just buy the stock now, but we're using the advantage of high volatility to actually make us this particular trade pay even more. And it's a credit trade, we're getting paid up front for placing a particular trade. So what did we do? We sold the GILD $95 October 16th expiry, guys. That's only 2 weeks away at a limit price of $341. So we got paid $341 for insuring the value of somebody else's shares to the value of $95. So what's our rationale? Well, GILD is trading at 97.20. We have a 12-month target price of 120. Implied volatility is extremely high at the moment. We showed you that earlier on in the chart. And we're happy to own the shares at 95 or even insure them at that level. Insure them at that level. We got paid for agreeing to buy the shares if they fall to 95. We're going to buy them anyway at 95, so we might as well get paid to do so. And we want implied volatility to fall. So we got paid $341 up front or $341 per contract, because one contract in the options market controls 100 shares of stock. So what's our risk in this trade? Well, technically our risk is if we're assigned the shares at 95 and they fall to zero. But that's a highly unlikely scenario to happen in the next 2 weeks. So our risk actually technically is our break-even point. And our break-even point is the strike price we picked minus the premium we got paid for insuring the stock. So our strike price was 95 minus the premium we took in for the shares, which is 341. So our break even was 91.59. So that's technically our risk if the share price fell to zero in 2 weeks, which is unlikely. The reality, as we're saying, is, however, is totally different. We like this stock. We think it's a value play. We're going to buy it anyway at 95. We might as well get paid for doing so. What's the max profit we can make in this trade? Well, if the share price of Gilead trades above 95, we've already taken in our insurance premium, and that's the max we can make in this particular trade. We can't make any more profit than that, but we're happy to have that profit. What's our break even? Well, I've said this already. On the short put strategy, the break even is equal to the strike price that you picked minus the premium you took in. So we picked the $95 strike. The premium we took in was $3.41, so our break even is $91.59. So as long as the shares of Gilead stay above $91.59 over the next 2 weeks, we're going to be making some sort of profit. We make our max profit when the shares are trading above $95. So what leeway did we give ourselves here? Well, when we placed the trade, the share price of Gilead was actually at 97.20. Our break even we know was 91.59, so the shares could actually fall 561. And you calculate that by just taking the share price at the time you placed the trade minus the break even point. So it could fall 561 before we start to make a loss, and in percentage terms that's 5.7%. So the shares can afford to fall another 5.7% in the next 2 weeks before we start to lose here. So what's the effect of volatility? We want implied volatility to drop now. That's a positive for us if it does. And time decay. So time decay is just a dollar amount every day that the value of an option erodes, and this is a positive for us. So as each day passes between now and expiry, assuming the share price doesn't drop, the value of our option should get cheaper, which makes our trade more profitable. So how do you go about picking the strikes? Well, I like the shares of Gilead at 95. That's why I picked this particular strike price. So you pick the strike price at the share price you want to buy the shares at. Now, if it's a return-based strategy, i.e. you're just trading the option, go as far out of the money as you can until you have at least an 80% chance of success. So it depends what mindset you've got here. Mindset number one, if you want to own the shares, pick that strike price. If it's a return-based strategy, make sure you have an 80% chance or more of winning. How do you go about managing the trade? Well, if you don't want to own if you do want to own the shares like I do, we'll do nothing and we'll just take the shares at 95. We're happy enough with that. But if you don't want to own the shares, you can do two things. You can buy back your put option at a loss, probably, or you can just roll out the put option for another month and actually take in even more credit, because you're basically insuring somebody else's shares for another month, which means that you're going to get an additional premium in. If you have any questions on this, please contact us. This is Stephen from Share Navigator with that trade alert on Gilead.